Alright guys, today we're diving into one of the boldest calls on Wall Street. Dan Ives, global head of tech research at Wedbush, just said, autonomous is a $1 trillion opportunity, and that Tesla's golden chapter starts now. 𝗗𝗟𝗏𝗧 joined him on CNBC's Closing Bell, and the debate sets the stage for what I think could be the next major re-rating in tech. Here's the game plan. I'm going to roll the Dan Ives clip so you can hear it straight from him. Then I'll come back with my reaction, my full breakdown of what he meant, what he implied, and what actually matters for your portfolio. And stick around, because after that I'll share my in-depth analysis of the 3 best tech stocks to buy now, based on this thesis and the data behind it. If you only watch one video today, make it this one, and watch it through to the end so you don't miss the picks and the reasoning. Smash the like button. Let's push this to 1,000 likes. Share it with someone who's watching the AI wave. Drop your thoughts in the comments, and subscribe so you never miss the next big investing update. Alright, let's hear what Dan Ives has to say.
Now let's bring in Wedbush Securities' Dan Ives and CNBC contributor 𝗗𝗟𝗏𝗧 of Requisite Capital. Dan, I come to you first. It's great to have you both with us. The street would seem to believe, only going, of course, through what the chart has shown us, that the worst is behind this name. You believe it is?
Oh, yeah, I think the worst is in the rearview mirror because, look, that was the Musk brand issues, what we saw with deliveries. Now you're seeing a stabilization. China continues to be the key, as Phil talked about. And I think that's actually an upward trajectory. Look, the reality is that's just an appetizer. It just sets the table to now it's going to be its most important chapter of growth ever, the autonomous and robotics future. And I think that's what's really the focus here. We think autonomous worth $1 trillion alone. That will be key on the call, laying out, we believe, 30 to 35 cities within the next year. That's how you get to a $2 trillion market cap. And we ultimately believe it's $3 trillion by the end of next year. And now this starts that golden chapter.
This idea of stabilizing, deliveries are still down 6%, I think, year over year. You had a pickup before the expiration of the tax credits expiring, so we have to be careful not to read too much into that for the overall story, I would think. And then if you look at the international picture, it doesn't look good. So what leads you to believe that the story truly has turned?
Well, I think it's really China. I mean, if you look at all the numbers coming out of China, I expect Musk to hit on the call. Stabilization to growth. You have refreshes coming out. You'll be on a trajectory going into next year, 550K per quarter. Look, in that, I mean, it's obviously that's very important, but the reality, what's going to drive the stock going forward, it's the AI chapter of growth that's coming. I mean, I believe as a physical AI play, Tesla and NVIDIA, the 2 best out there. And now you actually start to see rubber meet the road. This is going to be the key. Stabilization on the core business. But, I mean, that's why Musk right now, wartime CEO, eventually XAI, the shareholder meeting, they'll own part of that. This becomes an AI story going forward.
Yeah, Bryn, I know how much of a fan you are of Musk. I mean, you've said as much. But that doesn't mean you're a huge fan of the stock, which, frankly, you haven't been over the last, 5-6 months or so. So where does that leave somebody like you as a shareholder today?
Well, to me, it's about adding to the position and then taking advantage when I feel it's overpriced. I added to the position, as we all know, around 290 when he announced the American Party, also at 320. And so when, once again, when he continues to do his little side hustles, the market sells off. It's a wonderful time to add to it. Right now, we're still too close, I think, from a stock perspective to that 2024 high, which is around in the 460s. And so I think that as we go into this earnings call, to kind of build on what Dan was saying, I do think we have peak EV sales over this quarter will be peak because of those pull forwards. But I don't think that is what's going to move the stock. And just to give some examples, with full self-driving, with the robo-taxis, I saw Sawyer made a really interesting post that in Q3, they announced that when you were using the autopilot, there was one crash every 6.3 million miles. If you look at NHTSA's data with just regular cars, it's one every 700,000. So that's incredible. And so I think that the market's going to want to see, are robo-taxis in Austin and the other cities going to be able to go unsupervised, like Elon said in the summer? And so I think it's going to come down to execution of the robotaxis in the short term. I also think Optimus, he's done podcasts. Those hands are really hard to get right. I think we're still going to be in that prototype stage as they roll out Optimus 3. So to your point about the stock price, I would add to the position around 390. I do think it's going to be constrained here up around it's at 436, but if it gets to 460, I don't see this quarter being the quarter that it breaks out.
See, Dan, that's so interesting to me because you have somebody who I think in the bigger picture is as bullish as you, but certainly has a more sober view of where the stock currently is, where it's come from, to where it is and where it might go in the near term. So how do you rebut that if you want to?
Yeah, and Bryn obviously brings up great points. I mean, to me, it's really about, picking your spots. It's obviously always tough on Tesla. I just view it as the underlying demand is stable relative to China. Margins, as Phil talked about, I think that site's uptick, going forward next few quarters. But Scott, the reality is the autonomous market, I think they're going to own 80% of it. In terms of worldwide. And this now starts, when you look at Optimus, I believe they'll talk about, what's going to be volume production in 2026. And that's why this is the most important chapter ever in Tesla's history. And that's why Musk right now is so engaged. And look, could you miss, here or there in terms of where the stock's going to go? But my view is this is a stock going to 600, 700, and I think beyond, just given where this now plays in the AI revolution. And I think Tesla continues to be the most undervalued AI name in the market.
First, Dan Ives' opening stance is clear. He thinks the worst is in the rearview mirror. In his view, the brand wobble and the soft deliveries phase are past tense, with signs of stabilization now showing up. He anchors that stabilization largely to China. Dan's not just talking about a bounce, he's framing China as the platform for the next leg higher. From there, he pivots quickly to what he calls the most important chapter in Tesla's history, autonomous driving and robotics. In his model, autonomy alone is $1 trillion opportunity, and management is expected to detail a rollout across roughly 35 cities over the next year. That's the mechanism he uses to justify a much higher market cap trajectory. He actually lays out a path to $2 trillion and ultimately $3 trillion by the end of next year, with this phase marking the beginning of a golden chapter. The subtext here is that Tesla's multiple would be less about carmaker comps and more about platform software comps if autonomy and robotaxis start to commercialize. Now, the pushback comes fast in the interview, and it's fair. Deliveries are still down about 6% year over year. There was likely a pull forward before certain tax credits expired, which can make a recent uptick look better than it really is. Internationally, not everything looks rosy, so the host presses, why believe the turn is real? Dan answers with 3 pillars. 1. Stabilization in China with more detail expected on the call. 2. Product refreshes rolling out. And 3. A trajectory to around 550,000 vehicles per quarter next year. But even he makes it clear, the core business stabilizes, while the driver of the next leg is AI, autonomy, and robotics. He explicitly groups Tesla with NVIDIA as the 2 best physical AI plays, and frames Elon Musk as a wartime CEO, steering the company through this transition. The implication is that this isn't just cyclical repair, it's strategic repositioning toward high-margin software and services layered on top of the fleet. Enter Ben Talkington with the shareholder's lens, and a more surgical approach to entries and exits. He likes Musk, but he's been cautious on the stock near term. His strategy is to add when the market sells off on Musk's side hustles or headlines, and trim when it feels stretched. He mentions adding around $290 and $320. Where is he now? He thinks we might be near peak EV sales this quarter due to those pull forwards, and he doesn't think plain, vanilla EV unit growth is what moves the stock from here. He shifts the conversation precisely where Dan wants it, autonomy and robotaxis execution. This is where he brings in a data point that caught my attention. A 𝗗𝗟𝗦𝗧 post, citing Q3 results showing 1 crash every 6.3 million miles when using autopilot, versus roughly 1 every 700,000 miles for regular cars, using NHTSA-type baseline data. The point of quoting that stat isn't to declare the debate over. It's to suggest Tesla's safety per mile trend is starting to look compelling at scale. But bin immediately ties that back to what the market actually needs to see. Unsupervised robo-taxi operation in Austin and other cities, like Elon suggested could happen in the summer. In other words, the narrative won't cash out until we see regulators, cities, and real-world deployments line up with those claims. Then he addresses Optimus, the humanoid robot program. He's realistic. The hands are really hard to get right, and we're still in the prototype stage, with an Optimus 3 iteration rolling out. Translation: promise is massive, but the near-term timeline is hardware hard, and capital markets should treat it as longer-dated optionality, rather than a next-quarter catalyst. On the stock itself, bin gives his levels. He'd add around $390. He sees the stock constrained in the 400s for now, and he's skeptical this quarter is the one that convincingly breaks through the prior high in the 460s. That's a classic technician meets fundamental stance. Respect the big story, but let price tell you when conviction is getting ahead of execution. Back to Dan for the rebuttal. He concedes that picking your spots in Tesla is always tough, but he doubles down on 3 claims. 1. Demand is stable, particularly relative to China. 2. Margins should tick up in the coming quarters. And 3. The big swing, Tesla could own 80% of the global autonomous market. He adds a meaningful timestamp. He expects the company to talk about volume production for Optimus in 2026. If that roadmap holds, it supports his view that Tesla is the most undervalued AI asset in the market, with a stock path to $600, $700 and beyond as the AI chapter gets priced in. So how do I synthesize this for you? Near-term versus long-term drivers. Both guests implicitly agree. Unit deliveries and auto margins still matter, but they won't re-rate the stock by themselves. The multiple expansion case rests on autonomy and robotics, essentially software and services revenue on top of an installed fleet, plus an eventual robotics business line. If you're long because of Model Y refresh timing or quarterly delivery beats alone, you're trading the wrong thesis. China is the fulcrum for the base business. Dan's stabilization call in China is the oxygen for the financials. Stabilized units support pricing power and gross margin repair. If China wobbles again, that directly contests his "worst is behind us" claim and pressures the bridge to the AI chapter. So, watch China commentary closely on the next call. Execution bar for autonomy is rising. The stat bin cites 6.3 N miles per crash on autopilot versus an 700K baseline is a strong headline, but investors need more than a ratio. They need regulatory progress, clear city-by-city rollouts, and evidence of truly unsupervised operations at scale. The market will reward proof, not just demos. Austin will be a litmus test. Robotaxi economics drive the valuation math. Dan's trillion-dollar autonomy estimate implies a software-like margin stack, subscriptions for FSD, revenue per mile for robotaxi fleets, and potentially platform fees if third parties participate. The minute investors get credible visibility on monetization per vehicle per year, even in a handful of cities, the multiple stops anchoring to carmakers. Optimus is real optionality, but timeline sensitive. Bin warns, we're still in prototype land. Dan plants a flag at 2026 for volume production talk. Your risk management should treat Optimus as a multi-year call option. The upside is massive if they nail manipulation, reliability, and cost, but you don't want your entire investment case to depend on a robotics S-curve arriving on schedule. Positioning and price discipline, Bin's playbook, buy weakness caused by headline noise, respect technical levels, and trim at euphoria, is a practical overlay on top of Dan's big picture thesis. If you believe in the autonomy and robotics arc, you still don't have to chase every spike. Let execution milestones be your trigger. What could prove Dan right or wrong quickly? Right. Concrete disclosure of 30-35 autonomy cities with timelines, first unsupervised miles in production settings, improving China margin, and any credible 2026 manufacturing path for Optimus. Wrong. Re-weakening demand in China, regulatory setbacks stalling unsupervised operation, slippage on Optimus hardware targets, or repeated pull-forward effects masking soft organic demand. Here's what I'll be watching next so we separate story from substance. City-by-city autonomy roadmap, names, dates, and operating conditions. Are we talking geo-fenced downtowns at limited hours, or broader coverage? Unsupervised operation proof points, even limited pilots with real customers would be huge. monetization specifics, updated pricing for FSD subscriptions, any per-mile economics for robo-taxi, and take rate trends in the existing fleet. China color, orders, pricing, and margin commentary. Are refresh cycles hitting? Optimus milestones, clear hardware revisions, dexterity demos tied to real factory tasks, cost-down trajectories, and any early customer interest beyond Tesla's own factories. Bottom line, the interview framed two truths that can coexist. In the short run, the stock's path through the 400s into prior highs requires patience and proof. In the long run, if autonomy and robotics hit real commercialization, Tesla's valuation framework changes, potentially dramatically. Dan is planting the flag on that long-run hill with aggressive share and market cap targets. Ben is telling us how to walk there without breaking an ankle on the way. If you're an investor, match your strategy to your belief. If you buy the physical AI platform thesis, your focus should be on autonomy rollouts, unsupervised milestones, and unit economics, and you use volatility as your entry tool. If you're skeptical, demand evidence, not promises, especially around robo-taxi deployment and Optimus timelines. Either way, after this interview, the homework is clear, the checkpoints are visible, and the next few quarters will tell us whether that golden chapter is beginning or still being drafted. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 3 best tech stocks to buy now in the market. First up is Endava, ticker DAVA, a seriously undervalued tech services provider that has been flying under the radar for too long. Endava isn't a household name, but it's the go-to partner for massive corporations needing digital transformation. They specialize in helping companies navigate the complex digital landscape, ensuring they stay competitive in an ever-evolving market. They help old-school industries, banking, insurance, retail, healthcare, modernize with better apps, cloud migration, and seamless customer experiences. Their expertise in these sectors allows them to offer tailored solutions that address specific industry challenges. Endava's business model is all about long-term, embedded relationships, not just one-off projects. This approach fosters trust and ensures that clients see them as indispensable partners in their digital journeys. This creates sticky, predictable revenue and deep integration with blue-chip clients. Their ability to consistently deliver value makes them a preferred choice for many top-tier companies. Their client list is impressive major players in finance, payments, and media, all investing billions in tech. These sectors are constantly evolving, and Endava's role in their transformation is crucial. Endava's global delivery model taps into top engineering talent in Central Europe and Latin America, offering high-quality work at competitive costs. This global reach allows them to leverage diverse skill sets and perspectives, enhancing their service offerings. This approach keeps profit margins healthy and gives them a real edge over competitors. By maintaining a lean and efficient operation, they can reinvest in innovation and growth. The company's growth is remarkable. Revenue has consistently grown 20 to 30% annually. This consistent performance is a testament to their effective business strategies and strong market position. The digital transformation market is a multi-trillion-dollar opportunity, and Endava is perfectly positioned to capitalize on this trend. As more companies recognize the need for digital innovation, Endava's services will be in even higher demand. Endava's stock has pulled back, but the fundamentals remain strong, making this a compelling entry point for long-term investors. The recent dip offers a rare opportunity to invest in a company with solid growth prospects at a discounted price. Endava is also investing heavily in AI, machine learning, and cloud computing, keeping them on the cutting edge. These technologies are not just buzzwords. They're integral to the future of digital transformation. Their moat isn't just technology. It's deep client relationships and high switching costs. Once a company partners with Endava, the integration is so deep that switching to a competitor would be costly and disruptive. Competitors can't easily replicate the trust and integration Endava has built. This trust is a significant competitive advantage, making it difficult for rivals to lure away their clients. Their land and expand strategy means they start small with clients, then grow their footprint as they prove value. This method allows them to build strong, lasting relationships while steadily increasing their revenue. Leadership is a major asset. CEO John Cotterill has steered the company from a small firm to a public powerhouse. His vision and leadership have been instrumental in Endava's success. We're looking at a company with $473.19 million market cap anchored by 2024 revenue of $740.75 million. Earnings per share come in at 0.48, which puts the stock at a 18.15 price-to-earnings multiple. Net income for the year is $21.21 million, implying a net margin of roughly 2.9%. A reminder that while top-line scale is there, profitability is still in the early innings. Financials are strong, healthy balance sheet, consistent cash flow, and disciplined expense management. These financial metrics indicate a well-managed company with a solid foundation for future growth. Endava isn't burning cash for growth, they're scaling sustainably. This sustainable approach ensures long-term viability and reduces the risk of financial instability. Diversification is another strength. They're not reliant on any single client or industry. This diversification spreads risk and provides multiple revenue streams, enhancing financial stability. This resilience makes their revenue streams more stable, even in downturns. Their ability to weather economic fluctuations makes them a reliable investment. The recent market volatility has created a rare buying opportunity for a high-quality, fast-growing company. Investors looking for long-term growth should consider adding Endava to their portfolios. Endava is a quiet compounder, reliable, scalable, and built for the long haul. Their consistent performance and strategic growth make them a standout in the tech services sector. It's not the flashiest stock, but it could be one of the most dependable wealth builders over the next decade. Investors seeking steady, long-term returns should take note. The demand for digital transformation is only growing, and Endava is a key enabler. Their expertise and track record position them as leaders in this booming market. As long as tech evolves, companies will need partners like Endava. Their ability to adapt and innovate ensures they will remain relevant and in demand. This is a stock to buy, hold, and let compound. The potential for long-term growth makes it a valuable addition to any investment portfolio. Of course, do your own research, but the story here is strong. The fundamentals, growth prospects, and market position all point to a bright future for Endava. Endava's execution, client base, and market opportunity make it a standout. Their ability to deliver consistent results sets them apart from the competition. Don't overlook this silent giant. Their quiet but steady growth could make them one of the best-performing stocks in the coming years. Endava, ticker DAVA, deserves a spot on your watch list. Keep an eye on this company as they continue to grow and innovate. Let's move to the next pick. Next up is Globant, ticker GLOB, a digital and cognitive transformation powerhouse that's redefining what it means to be a technology partner in today's rapidly evolving world. Founded in Argentina in 2003, Globant has grown from a regional player into a global force, now operating in over 30 countries and serving some of the world's most influential brands. If Endava is the digital engineer, Globant is the AI innovator, helping global brands like Google and EA reinvent themselves for the digital age. Their work goes far beyond simple software development. They're at the forefront of integrating artificial intelligence, machine learning, and automation into the very core of their clients' businesses. Their unique studio model organizes talent into specialized teams: AI, cloud, gaming, blockchain, allowing deep expertise and agile problem solving. Each studio acts almost like a mini company, focused on a specific technology or industry, which means clients get the benefit of both broad capabilities and deep focused knowledge. This approach lets Globant deliver tailored, sophisticated solutions that generic IT outsourcers can't match. Whether it's building a next-gen gaming platform or reimagining a bank's customer experience with AI, Globant's teams are equipped to handle the most complex digital challenges. Globant has been investing in AI for years, building real expertise and credibility. Their early commitment to AI and cognitive technologies has positioned them as a trusted advisor for companies looking to future-proof their operations. As every company scrambles for an AI strategy, Globant is the go-to partner for complex, high-value projects. They don't just implement technology, they help clients rethink their business models, unlock new revenue streams, and gain a competitive edge in their industries. Their global delivery model, especially in Latin America, gives them access to top talent at competitive costs. With development centers in Argentina, Colombia, Brazil, and beyond, Globant can scale quickly and deliver high-quality work while maintaining cost efficiency. Growth has been spectacular, revenues up 25% plus annually, both organically and through smart acquisitions. This consistent double-digit growth is a testament to their ability to win new business and expand existing relationships, even in challenging economic environments. Their M&A strategy adds new capabilities and expands their geographic reach. By acquiring innovative firms in areas like cybersecurity, design, and cloud, Globant keeps its service offering fresh and relevant. Like Endava, Glob's stock has corrected, but the business fundamentals are stronger than ever. For long-term investors, these dips can be opportunities to buy into a high-quality company at a discount. Demand for AI and cloud services is surging, and Globant is at the epicenter of these trends. As more companies migrate to the cloud and seek to harness the power of data, Globant's expertise becomes even more valuable. Their client base is diverse: media, finance, travel, retail, tech, with long-term relationships like Disney. This diversity insulates them from sector-specific downturns and gives them insight into a wide range of business challenges. Company culture is a major asset. Globers are entrepreneurial, creative, and loyal, giving Globant a talent moat. Their focus on continuous learning and innovation keeps them ahead of the curve and makes Globant a magnet for top tech talent. The company generated $241 billion in revenue in 2024 and delivered $165.73 million in net income, translating to an EPS of $2.45. At a $2.63 billion market cap and a 24.45 PE, investors are paying a premium relative to Endava for higher margins, about 6.9% on the bottom line, and a more established earnings profile. Financials are rock solid: strong balance sheet, low debt, and flexibility for growth and acquisitions. This financial strength allows them to invest in R&D, pursue strategic deals, and weather market volatility with confidence. The co-founders are still involved and significant shareholders, aligning their interests with investors. Their long-term vision and hands-on leadership have been key to Globant's sustained success. Globant's focus on cognitive transformation, using data and AI to rethink business processes, means higher value, more profitable services. They're not just automating tasks, they're helping clients unlock new ways of working and new sources of value. The total addressable market is massive, with room for multiple winners like Globant and Endava. As digital transformation accelerates worldwide, the demand for Globant services is only set to grow. Investing in Globant means backing a design and innovation leader shaping the future of entire industries. Their projects touch everything from entertainment and finance to healthcare and retail, making them a true partner in transformation. Their blend of creativity and engineering is unique and powerful. It's this combination that allows Globant to deliver not just functional solutions, but experiences that delight users and drive real business results. The recent stock dip is a gift. Rarely do you get a world-class company at a reasonable valuation. For those with patience and vision, Globant offers a compelling entry point. For exposure to AI, cloud, and digital transformation, Globant is a fantastic choice. Their track record of innovation and execution makes them a standout in a crowded field. They have the clients, expertise, talent, and leadership to win for years to come. As technology continues to reshape every industry, Globant is positioned to be a long-term winner. This is a company that consistently executes and delivers. Their ability to turn vision into reality is what sets them apart from the competition. Don't let short-term volatility distract you. The long-term story is bright. Globant's relentless focus on innovation and client success makes them a company to watch for the next decade and beyond. Globant is a top contender for any growth portfolio. Their combination of vision, execution, and financial strength is rare in the tech world. Their innovation and execution set them apart. They're not just keeping up with the future, they're helping to invent it. If you want a stake in the future of tech, keep an eye on Globant. This is a company with the vision, talent, and drive to lead the next wave of digital transformation. Now let's look at our final pick. On to 𝗗𝗟. Our third pick is 𝗗𝗟, ticker 𝗗𝗟, an Israeli software giant dominating customer experience and financial crime prevention. Founded in 1986, 𝗗𝗟 has grown into a global leader, providing innovative solutions that help organizations improve their customer interactions and ensure compliance with financial regulations. 𝗗𝗟 leads in contact center as a service, CCaaS, powering the software behind major companies' customer interactions. Their technology is the backbone of many customer service operations, ensuring seamless and efficient communication between businesses and their clients. Their flagship platform, 𝗗𝗟𝗏𝗧, is a cloud-based suite managing voice, email, chat, and social media at scale. This comprehensive solution allows companies to handle all customer interactions from a single platform, enhancing efficiency and customer satisfaction. The business model is built on recurring high-margin subscription revenue, sticky and predictable. This model not only ensures a steady stream of income, but also fosters long-term relationships with clients, making it difficult for competitors to lure them away. Once a company adopts 𝗗𝗟𝗏𝗧, switching costs are huge, locking in clients for the long term. The integration of 𝗗𝗟𝗏𝗧 into a company's operations is so deep that moving to a different platform would be both costly and disruptive. The shift from on-premise to cloud is a major growth driver, and 𝗗𝗟𝗏 is leading the migration. As more businesses recognize the benefits of cloud computing, 𝗗𝗓 is well positioned to capture a significant share of this expanding market. AI is infused throughout their platform, automating tasks, guiding agents, analyzing interactions, and predicting customer needs. This advanced technology not only improves efficiency, but also enhances the quality of customer service by providing personalized and timely responses. Their massive dataset creates a data moat. The more customers they have, the smarter their AI gets. This self-reinforcing cycle ensures that 𝗗𝗓's AI capabilities continue to improve, providing a significant competitive advantage. On the financial crime side, 𝗗𝗓's Actimize platform is the industry standard for anti-money laundering and fraud detection. This platform helps financial institutions detect and prevent fraudulent activities, ensuring compliance with regulatory requirements. Banks rely on Actimize to monitor trillions in transactions and stay compliant. Demand here is only rising. As financial regulations become more stringent, the need for robust compliance solutions like Actimize continues to grow. This dual focus gives 𝗗𝗓 diversified, resilient revenue streams. By serving both customer experience and financial crime prevention markets, 𝗗𝗓 reduces its dependency on any single sector, enhancing its overall stability. 𝗗𝗓's stock has come down to a more attractive valuation, making it a compelling buy. The recent dip presents a great opportunity for investors to acquire shares at a lower price with the potential for significant future gains. Software margins are high, and as more clients join the cloud platform, profits scale rapidly. The scalability of their cloud solutions means that as their customer base grows, their profitability increases exponentially. Management, led by CEO 𝗗𝗟𝗨𝗦, has executed a brilliant shift from legacy hardware to cloud-first software. This strategic pivot has positioned 𝗗𝗓 at the forefront of the industry, driving innovation and growth. 𝗗𝗓's services are non-discretionary. Companies can't turn off customer support or compliance, even in downturns. This makes 𝗗𝗓's offerings essential, ensuring steady demand, regardless of economic conditions. Their competitive position is strong, more customers, features, and credibility than rivals like Five9 or Genesys. 𝗗𝗓's comprehensive solutions and established reputation give it a significant edge in the market. They're expanding their platform to cover the entire customer journey, workforce optimization, analytics, and more. This holistic approach ensures that businesses can manage every aspect of customer interaction from a single, integrated platform. The financial crime business is also growing as regulations tighten and digital payments rise. With the increase in digital transactions, the need for advanced fraud detection and compliance solutions is more critical than ever. 𝗗𝗓 consistently beats earnings expectations and provides conservative guidance. This track record of outperformance and prudent management instills confidence in investors. This reliability is a hallmark of a well-managed company. 𝗗𝗓's consistent performance and strategic vision are testaments to its strong leadership and operational excellence. With a market cap of $8.24 billion, 2024 revenue of $2.73 billion, and net income of $442.58 million, the company posts EPS of 8.37 and trades at a 15.77 PE. That implies a net margin just over 16%, combining solid scale with efficient earnings generation and, notably, the lowest earnings multiple of the three. An interesting setup for value-oriented investors who still want exposure to durable cash flows. For investors, 𝗗𝗓 offers growth, profitability, a durable moat, and resilience. These attributes make it an attractive addition to any investment portfolio, particularly for those seeking long-term growth. It's a growth at a reasonable price play, paying a fair price for a proven leader. This investment strategy ensures that investors are getting value for their money, with the potential for substantial returns. The dual engines of cloud customer experience and financial crime compliance set 𝗗𝗓 up for sustained growth. This dual focus not only diversifies their revenue streams but also positions them for continued success in two critical areas. This is a high-quality name for any tech portfolio. 𝗗𝗓's robust business model, innovative solutions, and strong market position make it a standout choice for tech investors. If you want a stock that quietly compounds wealth, 𝗗𝗓 is it. Its steady growth and reliable performance make it an excellent choice for long-term investors looking to build wealth over time. Don't overlook this software powerhouse. 𝗗𝗓's innovative solutions and strong market presence make it a key player in the tech industry. 𝗗𝗓, ticker 𝗗𝗓, is a must-watch. Let's wrap up. There you have it. Endava, Globant, and 𝗗𝗓, three tech giants powering the digital world from behind the scenes. These aren't speculative bets, they're established leaders with strong growth and attractive valuations. The real opportunity for outsized returns often lies in finding these high-quality compounders before they're household names. Which of these three do you think has the most long-term potential? Let us know in the comments. For exclusive stock tips and in-depth analysis, join the Stocks Galore Patreon, link in the description. Don't forget to like, comment, and subscribe for more investing insights. Thanks for watching. See you in the next one.